In the early hours of August 2021, a group of hackers known as the Poly Network exploiters made off with a staggering $610 million in cryptocurrency from a decentralized finance platform, marking one of the largest digital heists in history. This brazen attack didn't just expose the vulnerabilities of the crypto world, but also highlighted the darker side of digital finance, the world of money laundering. The question on everyone's mind was, how could such a massive amount of money be stolen and potentially laundered without being detected? And what does this say about the security and regulatory oversight of the cryptocurrency market? The core of this mystery lies in the nature of cryptocurrencies themselves. Designed to be decentralized and unregulated, they offer a level of anonymity that traditional banking systems do not. This anonymity, while attractive for privacy reasons, also makes cryptocurrencies a haven for illicit activities, including money laundering. The Poly Network heist, for instance, involved the exploitation of a vulnerability in the platform's code, allowing the hackers to transfer assets to their own accounts. But what's even more intriguing is how these stolen assets could be laundered and integrated back into the legitimate financial system. The complexity of tracing cryptocurrency transactions, due to their decentralized and often anonymous nature, poses a significant challenge to law enforcement and regulatory bodies. As investigators dug deeper into the Poly Network heist, they uncovered a web of complex transactions and wallet addresses, leading them on a global chase to track down the perpetrators. But that wasn't the strangest part. The hackers, in a surprising move, began returning the stolen funds, citing that they had always intended to expose the platform's vulnerabilities, not to keep the money for themselves. This unexpected turn of events raised more questions than answers. Were these hackers truly altruistic, or was this a clever ploy to avoid detection and prosecution? And what about the underlying issue of money laundering in the crypto space? The return of the funds, while a relief, didn't solve the systemic problems that allowed such a heist to occur in the first place. The scale of digital money laundering schemes extends far beyond the Poly Network incident. According to the United Nations, it's estimated that around $1.6 trillion to $2 trillion is laundered annually, with a significant portion of this amount moving through the cryptocurrency market. This staggering figure highlights the immense challenge faced by regulatory bodies in tracking and preventing such activities. The use of cryptocurrencies like Bitcoin and Ethereum, along with the emergence of privacy coins and decentralized exchanges, has made it increasingly difficult for authorities to follow the money trail. But what's critical to understand is that money laundering in the crypto space isn't just about the technology itself, but about the people and networks behind these transactions. As we delve deeper into the world of cryptocurrency and money laundering, it becomes clear that the line between legitimate transactions and illicit activities is often blurred. High-profile cases like the Silk Road, where Bitcoin was used to facilitate drug trafficking, or the more recent case of the Russian money laundering ring using cryptocurrency to move millions of dollars, illustrate the scope of the problem. But for every high-profile case, there are countless smaller operations that fly under the radar, exploiting the anonymity and decentralization of cryptocurrencies for their illicit gains. The question then becomes, how can regulatory bodies and law enforcement agencies effectively combat money laundering in the crypto space without stifling innovation and the legitimate use of digital currencies? The answer to this question is complex and multifaceted. It involves a combination of technological solutions, such as advanced blockchain analytics, and regulatory measures like Know Your Customer (KYC) and anti-money laundering (AML) laws. However, the implementation of these solutions is not without its challenges. The crypto community has long been resistant to regulation, arguing that it undermines the decentralized and anonymous nature of cryptocurrencies. On the other hand, regulatory bodies face the daunting task of keeping pace with the rapidly evolving crypto landscape, where new technologies and platforms emerge almost daily. But that's not the only contradiction. As governments and regulatory agencies push for stricter controls, they also recognize the potential of cryptocurrencies to revolutionize financial inclusion and access to capital. This paradox, the dual potential of cryptocurrencies for both good and ill, is at the heart of the challenge in combating digital money laundering. The Poly Network heist and other large-scale digital money laundering schemes have sounded the alarm, prompting a renewed focus on security, regulation, and international cooperation. But as the crypto market continues to grow, with more people and institutions investing in digital assets, the stakes have never been higher. The race between regulators and those seeking to exploit the system for illicit gains is ongoing, with the outcome far from certain. As we explore the depths of this issue, one thing becomes clear. The future of the cryptocurrency market, and its potential to be a force for good, hinges on our ability to address the challenges of money laundering and ensure that this technology serves the greater good, rather than the interests of a few. But that's a story that's still unfolding, with new twists and turns emerging every day, leaving us to wonder, what's the next big heist, and how will it change the landscape of digital finance forever? As we delve deeper into the world of digital money laundering, it becomes increasingly clear that the lines between legitimate financial transactions and illicit activities are often blurred. One of the most significant challenges in tracking down crypto heists is the use of cryptocurrency tumblers, or mixers, which allow users to obscure the origin of their funds by pooling them with other transactions. This makes it nearly impossible to identify the source of the money, leaving investigators with a complex web of digital breadcrumbs to follow. But that wasn't the only hurdle they faced, as the rise of decentralized finance, or DeFi, has created new avenues for money launderers to exploit. The DeFi sector has grown exponentially in recent years, with the total value locked in DeFi protocols surpassing $100 billion. While this growth has brought new opportunities for legitimate investors, it has also created an environment where illicit activities can thrive. The use of smart contracts, for example, has allowed money launderers to create complex networks of transactions that are difficult to track. Furthermore, the anonymity of cryptocurrency transactions has made it easier for individuals to move large sums of money without being detected. But as investigators began to crack down on these activities, they discovered that the problem was far more widespread than they had initially thought. One of the most significant crypto heists in recent history was the hacking of the Poly network, a decentralized finance platform that allows users to transfer assets across different blockchain networks. In August 2021, hackers stole over $600 million in cryptocurrency from the platform, making it one of the largest crypto heists on record. The hack was particularly notable because of the way the hackers operated, using a combination of social engineering tactics and exploiting vulnerabilities in the platform's code. But what's even more intriguing is that the hackers eventually returned nearly all of the stolen funds, citing that they had only wanted to expose the platform's vulnerabilities. But that wasn't the strangest part. As investigators dug deeper into the hack, they discovered that the attackers had used a complex network of cryptocurrency wallets and exchanges to move the stolen funds. The use of these intermediaries made it difficult to track the money, but it also revealed a larger pattern of money laundering activity. It became clear that the hackers were not acting alone, but were instead part of a larger network of individuals and organizations that were working together to launder money through the cryptocurrency markets. This realization raised more questions than answers, as it highlighted the scale and complexity of the problem. But it also brought investigators closer to uncovering the truth behind the biggest crypto heists. The investigation into the Poly network hack was a major turning point in the effort to combat crypto money laundering. It marked a shift in focus from individual hacks to the broader ecosystem of cryptocurrency exchanges, wallets, and other services that facilitate these activities. As regulators and law enforcement agencies began to pay closer attention to these services, they discovered that many of them were not doing enough to prevent money laundering. In fact, some exchanges were found to be actively facilitating these activities, either through negligence or complicity. This midpoint in the investigation reframed the entire narrative, as it became clear that the problem of crypto money laundering was not just about individual hackers, but about a systemic failure to regulate and oversee the cryptocurrency markets. The lack of regulation and oversight in the cryptocurrency markets has created an environment where money laundering can thrive. The use of Know Your Customer, or KIC, and anti-money laundering, or AML, protocols is not universal, and many exchanges and services do not have the necessary systems in place to detect and prevent illicit activities. This has created a situation where criminals can easily move large sums of money through the cryptocurrency markets without being detected. But as regulators began to crack down on these activities, they faced significant pushback from the cryptocurrency community. Many argued that increased regulation would stifle innovation and drive activity underground, making it even harder to track and prevent money laundering. The debate over regulation has been a contentious issue in the cryptocurrency community, with some arguing that it is necessary to prevent money laundering and others claiming that it will undermine the very principles of decentralization and anonymity that underpin the technology. But as the stakes continue to rise, it is becoming increasingly clear that some form of regulation is necessary to prevent the cryptocurrency markets from being exploited by criminals. The question is, what form will this regulation take, and how will it balance the need to prevent money laundering with the need to protect the integrity of the cryptocurrency markets? But that's a question that will have to be answered by policymakers and regulators as they navigate the complex and ever-evolving landscape of digital finance. As we continue to navigate this complex landscape, it's becoming increasingly clear that the problem of crypto money laundering is not just a technical issue, but a deeply human one. It's a problem that requires a nuanced understanding of the motivations and behaviors of individuals and organizations, as well as the complex systems and networks that they operate within. It's a problem that requires a multidisciplinary approach, one that brings together experts from fields such as finance, technology, and law enforcement to develop effective solutions. But as we move forward, it's also important to recognize that the cryptocurrency markets are not a static entity, but a dynamic and evolving system that is constantly adapting to new challenges and opportunities. The adaptability of the cryptocurrency markets is both a blessing and a curse. On the one hand, it has allowed for the development of new and innovative financial instruments and services that have the potential to democratize access to financial services and create new opportunities for economic growth. On the other hand, it has also created an environment where illicit activities can thrive, as criminals are able to exploit vulnerabilities and weaknesses in the system to move and launder money. But as investigators and regulators continue to evolve their approaches to combating crypto money laundering, it's becoming increasingly clear that the key to success lies in developing a deeper understanding of the complex interplay between technology, finance, and human behavior. But what's still unclear is how this will play out in the long term, and what the ultimate consequences will be for the cryptocurrency markets and the broader financial system. As regulators and law enforcement agencies scramble to keep pace with the evolving landscape of crypto money laundering, they're being forced to confront the darker side of human nature, where the pursuit of profit can lead individuals and organizations down a perilous path of deceit and corruption. The numbers are staggering, with estimates suggesting that upwards of $2 billion in cryptocurrency is laundered annually, a figure that's likely a mere fraction of the true total. But what's perhaps even more alarming is the role that legitimate financial institutions are playing in facilitating these illicit transactions, often unwittingly, but sometimes with a disturbing level of complicity. The case of Danske Bank, which was found to have laundered an estimated $230 billion in dirty money through its Estonian branch, serves as a stark reminder of the dangers of unchecked greed and the failures of regulatory oversight. But that wasn't the strangest part, as it's now coming to light that many of these financial institutions have been actively courting cryptocurrency businesses, touting their ability to provide the necessary infrastructure for these companies to operate, all while turning a blind eye to the obvious risks of money laundering. This has created a perverse incentive structure, where the very same banks that are supposed to be preventing illicit activity are instead enabling it, all in the name of profit. As the crypto money laundering schemes continue to escalate, it's becoming increasingly clear that the only way to effectively combat them is through a coordinated, international effort. But achieving this level of cooperation is proving to be a daunting task, as different countries and regulatory bodies have vastly different approaches to dealing with cryptocurrency. The European Union, for example, has implemented a sweeping set of regulations known as the Fifth Anti-Money Laundering Directive, which requires crypto exchanges and custodial wallets to implement robust Know Your Customer and anti-money laundering controls. But in other parts of the world, such as Japan and Singapore, the approach is far more permissive, with regulators taking a more hands-off approach to overseeing the crypto industry. This patchwork regulatory landscape has created a situation where crypto money launderers can simply pick and choose which jurisdictions to operate in, based on which ones have the weakest controls. It's a classic case of regulatory arbitrage, where the lack of a unified global approach is being exploited by those seeking to launder their ill-gotten gains. But what's even more concerning is the role that cryptocurrency mixers, also known as tumblers, are playing in facilitating these transactions. These services, which allow users to obscure the origin of their cryptocurrency by mixing it with other funds, have become a key component of the crypto money laundering ecosystem, making it virtually impossible to track the flow of dirty money. The use of these mixers has become so widespread that it's now estimated that upwards of 10% of all Bitcoin transactions are being laundered through them. But that's not the only way that crypto money launderers are using technology to stay one step ahead of the law. They're also employing advanced techniques such as chain hopping, where they rapidly switch between different cryptocurrencies in order to obscure the trail of their transactions. It's a cat-and-mouse game, where the perpetrators are constantly evolving their tactics in response to the efforts of law enforcement to keep up. And it's a game that's being played out on a global scale, with the stakes higher than ever before. As the crypto money laundering schemes continue to escalate, it's becoming increasingly clear that the only way to effectively combat them is through the development of new technologies and techniques. This includes the use of artificial intelligence and machine learning to monitor and analyze cryptocurrency transactions, as well as the implementation of more robust Know Your Customer and anti-money laundering controls. But even as these solutions are being developed, it's becoming clear that the problem of crypto money laundering is far more complex and multifaceted than initially thought. It's a problem that requires a deep understanding of the underlying technology, as well as the social and economic factors that are driving it. The reality is that crypto money laundering is not just a technical problem, but a human one, driven by the same motivations and desires that have always driven illicit activity. It's a problem that requires a nuanced and multifaceted approach, one that takes into account the many different factors that are contributing to it. And it's a problem that's unlikely to be solved anytime soon, as the pace of technological change continues to outstrip our ability to keep up. But one thing is certain: the consequences of inaction will be severe, and the future of the cryptocurrency markets and the broader financial system hangs in the balance. And as we move forward into this uncertain future, one question remains: will the next great crypto heist be the one that finally brings down the entire system?